There have been increasing discussions recently about the long-term future of the U.S. dollar and whether its global dominance could face new challenges. For decades, the idea of replacing the dollar as the world's primary reserve currency has largely remained theoretical. However, recent global economic conversations, including debates among policymakers and economists, have reignited this topic. Some public statements from political and financial figures have drawn attention. Certain officials have suggested that concerns about foreign countries reducing their holdings of U.S. debt may be overstated. Others have argued that currency fluctuations can sometimes support economic adjustments, particularly in export competitiveness. These comments have sparked mixed interpretations among analysts. Some view them as strategic positioning, while others see them as reflections of broader economic pressures. The discussion around a weaker dollar is complex. Historically, a declining currency can sometimes support exports by making domestic goods cheaper for foreign buyers. However, it can also increase the cost of imports and potentially reduce purchasing power. Economists remain divided on whether a weaker dollar would significantly benefit the U.S. economy, especially during periods of trade tensions or tariff disputes. From an investment perspective, currency movement can influence returns. For example, if financial markets rise but the domestic currency weakens against global currencies, international investors may see reduced real returns. This is one reason why currency stability is often viewed as important in maintaining investor confidence. Foreign investors play a significant role in U.S. financial markets. International buyers hold a notable portion of U.S. Treasury securities, equities, and corporate debt. Because of this global participation, shifts in international sentiment can influence financial stability. However, the U.S. financial system still benefits from deep liquidity, strong institutions, and long-standing trust from global investors. At the same time, China has been gradually expanding the international role of its currency, the renminbi. Chinese policymakers have repeatedly expressed interest in increasing the currency's use in global trade and finance. Many economists believe that for any currency to become a major reserve asset, it must be widely used in international transactions and investment flows. China's large export sector naturally supports this strategy. When countries import Chinese goods, settlement can sometimes occur in renminbi rather than U.S. dollars. Over time, this may slowly increase global familiarity with the currency. However, the renminbi still faces structural challenges, including capital controls and regulatory restrictions that limit full international convertibility. Trade dynamics have also shifted in recent years. China has expanded trade relationships across Asia, Africa, and parts of Europe. Increased regional trade can encourage local currency settlement arrangements. While this trend could gradually diversify global currency usage, most analysts believe the dollar still holds a dominant position due to its deep financial markets and global liquidity. Another important factor is global borrowing. Many governments and corporations continue to borrow in U.S. dollars because of the size and accessibility of dollar-denominated credit markets. This creates continuous demand for the currency, reinforcing its global role. China has attempted to expand renminbi-denominated lending through infrastructure and development financing initiatives, but this remains a smaller portion of global debt markets. Currency stability also influences investor behavior. Export-driven economies sometimes prefer weaker currencies to maintain trade competitiveness. However, reserve currencies often benefit from long-term stability, which encourages foreign asset investment. Some financial institutions have suggested that China may allow moderate currency appreciation under certain economic conditions, though future policy decisions remain uncertain. Energy trade and global commodity flows also play a role in currency competition. Oil and natural gas transactions have historically been priced largely in U.S. dollars. This practice has supported long-standing demand for dollar reserves worldwide. However, some countries have explored alternative settlement mechanisms, particularly in bilateral trade agreements. Geopolitical relationships further influence these economic shifts. Trade negotiations, sanctions, supply chain restructuring, and regional partnerships can all affect currency usage. In recent years, several governments have emphasized diversification in trade and resource partnerships to reduce reliance on any single market. For example, evolving energy infrastructure projects in North America and Asia may influence future commodity supply chains. Expanded shipping routes or pipeline networks could reshape trade patterns, though these developments typically take years to fully materialize and depend heavily on regulatory approvals, economic viability, and political cooperation. Global oil markets themselves remain highly interconnected. Supply adjustments from countries like Venezuela, Russia, and Middle Eastern producers can shift pricing dynamics. Meanwhile, both the United States and China continue seeking stable long-term energy supply and export opportunities, often balancing economic and strategic priorities. Looking forward, most economists agree that replacing a global reserve currency is historically rare and usually occurs over decades rather than years. The U.S. dollar continues to benefit from strong financial infrastructure, large capital markets, and widespread global trust. At the same time, rising economic powers are gradually exploring ways to expand their financial influence through trade, lending, and investment initiatives. Whether these efforts eventually create a multi-currency global system remains uncertain. Some analysts believe the future may involve diversification rather than outright replacement, with multiple currencies sharing global reserve functions. Ultimately, currency dominance is shaped by trade networks, financial transparency, investor trust, geopolitical stability, and long-term economic performance. These factors evolve slowly, making the global currency landscape one of the most closely watched areas in international finance.